Welcome to The Explainer. Today, we're diving straight into Episode 1, Part 2B, getting right into the weeds of the advanced post-purchase rules of capital gains tax planning under the new Income Tax Act 2025. We're going to break down the absolutely critical, yet somehow constantly overlooked, subsections of Section 82. These are the rules that dictate exactly what happens to you after you've gone ahead and claimed your initial tax exemption.
Look, I need to challenge a really dangerous illusion right out of the gate. There is this massive misconception out there. So many taxpayers think, hey, I sold my old house, I bought a new one, I claimed my exemption, my tax planning is totally done. Well, actually, scratch that. Let me be perfectly clear. Purchasing that replacement property is literally just the beginning of your compliance journey. If you tune out after you get the keys to the new house, you're leaving yourself completely exposed to some nasty future tax notices.
So here's our roadmap for today. 1. The post-purchase tax trap. 2. The deemed cost mechanism. 3. Unutilized capital gains accounts. 4. Two-house reinvestment option. 5. The 10 crore cap. And 6. Avoiding costly compliance mistakes. Let's jump right into Section 1. The post-purchase tax trap. Why buying is just the beginning. The new 2025 Act focuses heavily on simplification, for sure, but make no mistake, it carries forward some incredibly strict post-purchase requirements that catch a lot of property sellers completely off guard. Securing that initial exemption, it's not a permanent gift, it's entirely conditional. Once you claim it, you're legally bound by the anti-abuse mechanisms built directly into Sections 82.3 through 82.7. The government is essentially saying, all right, we'll give you the tax break now, but you better believe we are going to watch exactly what you do with this new property.
Moving right along to Section 2, the deemed cost mechanism under Section 82.3.
To really grasp the legal penalty for selling your new house too quickly, let's look at how this plays out in the real world. Let's take a guy named Rajesh. Step 1. Rajesh sells his old house and triggers an 80 lakh rupee long-term capital gain. Step 2. He buys a brand new house and successfully claims his exemption under Section 82. Everything looks absolutely perfect, right? But then, Step 3, just 2 years later, he decides to sell that new house well within the statutory lock-in period. Here is where Step 4 hits him like a ton of bricks. The tax department doesn't just ask for the old tax back. Instead, they take that earlier exemption amount and adjust it against the cost of acquisition of this new house when computing the gains on this second sale. So, just to be crystal clear, here is what the deemed cost mechanism actually is. It's an anti-abuse provision. If you sell that replacement property too early, your earlier exemption actively influences your new cost computation. Because your cost of acquisition is artificially lowered by that previous exemption amount, your taxable profit on this new sale shoots up significantly. The original tax isn't just demanded back. It's cleverly, almost invisibly, embedded right into your next transaction's tax math.
All right, Section 3, unutilized capital gains accounts under Section 82.4.
This brings us to the next major trap, specifically for anyone using the Capital Gains Account Scheme, or CGAS. A lot of taxpayers park their money in a CGAS account to preserve their exemption while they house hunt, which is smart. But CGAS is literally a ticking clock. At year 0, the property is sold, funds are safely deposited. Awesome. But you only have 2 years to purchase a new house, or 3 years to construct one. If that 2-year mark passes without a purchase, and then that 3-year construction deadline passes, well, the statutory limit expires. The very second that 3-year deadline hits, the tax hammer falls. Let me tell you about Anita. She sold her property and deposited 90 lakh rupees into a CGAS account. For 3 straight years, she searched for the perfect villa. She negotiated, she looked at different cities, but ultimately, she bought nothing. She just assumed that because her money was sitting safely in a government-notified CGAS account, her exemption was permanently locked in. That is a massively costly myth. Under Section 82.4, once that prescribed period expires without utilization, the entire unutilized balance becomes fully taxable. And this brilliantly illustrates what we call the Section 536 transition trap. Listen up, because this is crucial for anyone who sold property under the old 1961 Act. If you deposited money in a CGAS account in, say, June 2024, your 3-year window expires in June 2027. That's well after the new 2025 Act takes effect. So what happens? Section 536 dictates that the tax department will evaluate your compliance based on the old rules, but they will officially tax you under the new act in the year you default. Yes, they have a very long memory, and they absolutely will audit your compliance years down the line.
Moving it to Section 4, the two-house reinvestment option under Sections 82.5 and 82.6.
No, Section 82 isn't entirely about traps and penalties. It actually offers an incredible strategic opportunity for certain taxpayers to diversify their real estate, unlocked by this magic number right here, 2 crore rupees. If your long-term capital gain from the sale of your residential house does not exceed 2 crore rupees, you get the highly coveted option of claiming your exemption by reinvesting those gains into not just one, but 2 separate residential houses in India. Picture a retired couple selling a huge family home and buying one plot in their hometown and another one close to their kids. It's an absolutely fantastic provision.
But hold on. There is a massive catch. Section 82.6 explicitly states that this two-house option is generally only available once in a lifetime. You can't just do this every time you sell a property. This makes it a major strategic financial decision. If you burn your one-time option today on a relatively small capital gain, you completely ruin your chances of using it later in life when you might have a much, much larger transaction. You really have to plan this strategically with a professional.
Okay, on to Section 5, the 10 crore cap under Section 82.7.
If you're a high net worth individual, this is a provision you absolutely must understand before signing your next massive sale deed. The 2025 Act ensures that tax exemptions are not just a bottomless pit. The absolute maximum statutory cap applied to the cost of a new residential asset when computing your exemption is exactly 10 crore rupees. It does not matter how grand, how expansive, or how luxurious your replacement property is, the math officially stops here. To put that into perspective, let's look at the math. Say you have a massive gain and you purchase a luxury property for 8 crore rupees. Great, the government will consider the full 8 crore for your exemption value. But if you go all out and purchase an ultra-luxury pad for 18 crore, hoping to absorb a huge capital gain, well, the government is going to apply that statutory cap. They will never consider an amount exceeding 10 crore for your tax relief. That extra 8 crore you spent on the house, it gives you absolutely zero additional capital gains tax benefit. Finally, Section 6, avoiding costly compliance mistakes.
We've covered the traps, the transition rules, the strategic options, and the statutory caps. Let's pull this all together into an actionable master checklist. Here are the top 5 practical mistakes that instantly trigger automated tax notices. Number 1, missing your 2-year purchase or 3-year construction deadlines. Number 2, failing to deposit unutilized funds into a CGAS account before your income tax return due date. And no, just holding it in your regular savings account will not cut it. 3, selling your replacement house within the lock-in period and accidentally triggering that deemed cost penalty. 4, assuming you can use the 2-house option more than once. And 5, not maintaining perfect documentary evidence. You need those sale deeds, purchase deeds, CGAS passbooks, and construction bills impeccably organized.
So, I'm going to leave you with this one provocative question. Looking at all these post-purchase complexities we just went through, from the deemed cost mechanism to the once-in-a-lifetime 2-house rule, is your tax strategy truly ready before you sign that sale deed? Because as we've clearly seen today, the most effective tax planning under the Income Tax Act 2025 happens long before the transaction ever takes place, not after. Start planning early, get a professional in your corner, and secure your financial future.